All right, so we are going to wrap up chapter 3. I've got a couple more comments about chapter 3. For those of you listening at home, I'm handing out a couple of handouts. These are statement of operations, Exeter Hospital, which is the one we went over in class, and then giving out a income statement from a for-profit physician practice. The for-profit physician practice is scanned in and in the module titled Chapter 3 handouts. All right, so we'll come to that in just a second. What I want to do is talk for a minute before we look at the physician practice. What I want to do is demonstrate something real quick, and that is, what does it look like if you have a for-profit entity that's versus a not-for-profit? So we talked about our 3 sections: operating revenue, right? So this is not-for-profit, this is for-profit, right? They both have operating revenue, no real difference. They both have operating expenses, no real difference. That gets you operating income. So you should have this structure. You should memorize this structure. It's just the 3 pieces. Right. So nonprofit, for-profit, they look the same, right? Then we have non-op gains or losses, non-op gains or losses, right? We add that to the operating income, and we get over here on the nonprofit side, we get our net income or excess of revenue over expenses, right? So for-profits don't call their net income. They typically call it something like excess of revenues over expenses. So they don't sound like they're making money, even though we all know that they have to make money because they need that profit in order to reinvest it back into their organization. Now, over here, we have our operating income and our non-operating income. That results in our taxable income. Okay, so all of the money that comes into the organization, less all of the expenses that the organization faces in the course of a year, results ultimately in a amount of income that the IRS will now tax. The federal government taxes using the IRS, right? The IRS doesn't do it on its own. So that becomes taxable income. Then you calculate the taxes, and then that becomes net income, right? So these are the same thing. They just call it something else. So the main difference between a for-profit and a not-for-profit income statement, other than the fact that the not-for-profits call their income statement of operations, is that this last section, what would be net income to a not-for-profit becomes taxable income for a for-profit. So basically, there's just another step. Yeah, Molly. Excess of revenue over expenses. No, so operating income hopefully is a positive number. Either way, it doesn't matter. Then you're looking at non-operating gains and losses. Could be a positive number or it could be a negative number. So I would say add it, and if it's a negative number, you're adding a negative, right? Which is essentially subtract. So I would just kind of keep in my head, I'm adding the non-operating gains and losses, and sometimes that number is negative. So when I add that negative number, I'm really subtracting.
So the difference between not-for-profit and for-profit, what would be a net income
just basically the not-for-profit stops at net income. And then the for-profit said, wait, there's more. We have to pay taxes now on whatever profits we made in the year. We have to now pay taxes on. Okay, so that's the main difference. So if you picked up a income statement and you're reading down, you don't know what kind of organization it is. The quickest way to figure out is go to the bottom and see if they pay taxes or not. If they pay taxes, they're a for-profit entity, right? Okay. So let's actually look at one, a for-profit. Now, this is not a real for-profit. This is a made-up textbook example. But this is the one you have that I just gave you. So this is a made-up physician practice. So what I want to point at is it's got the same basic 3-section structure. They organize their expenses. They kind of break their expenses up into like subcategories, but it's still operating expenses. So we'll talk about that in a minute. So top line, top section, operating revenues. They just call it revenues. What do they have? Patient service revenue, net of contractual allowances and discounts. Hey, that's something we talked about, right? That's our gross patient service revenue, the stuff the amount we build out, knowing that we're not going to collect it. That's our, gross patient service revenue is our monopoly money bill, right? The number we send out that we know we're not going to collect, less our contractual allowances. So those are our charity care, as well as any discounts that we've agreed to in our negotiations with our insurance companies, or discounts that we're having pushed on us by the federal government in the form of Medicare and Medicaid reimbursement. That gets us to that top line, patient service revenue, net of contractual allowances and discounts. And we have provision for bad debts, just like we talked about before. Provision for bad debts, that's the thing where we're like, we didn't collect money, right? We're a accrual basis organization. When a patient rolls through here and we see them, we are maybe collecting a fraction of that bill in the form of a copay or some small amount. But the bulk of what we expect to collect is we're going to bill out and we're going to get later. And we know some people just don't pay their bills. Most people are fine and they pay their bills, but there's some percentage. So we're taking an allowance or a provision, meaning we don't know the final number yet, but we're cutting off at the end of the fiscal year. Fiscal year means the year that not all organizations run on a calendar year. Like most businesses do not run on a calendar year, January to December. The university, for example, runs July to June. The federal government runs October 1st to September 30th. So we're coming up on the end of the fiscal year for the federal government. A lot of organizations that work with the federal government set their fiscal year to match the federal government's fiscal year, just because it makes their revenues come from the federal government, just makes it easier for them to run at the same time. Corporations can set their fiscal year to whatever they want. You can run April 3rd to April 2nd, if that's what you want, for some random, bizarre reason, right? Most people, there are some kind of standard ones. Most people either match like the federal government, going October 1st to September 30th, or they do, schools run July to June. So there's usually a business reason why they set their fiscal year different than the calendar year. But a corporation gets to decide that. So let's say we cut off at the end of the fiscal year. We're a physician practice in this case, right? We send out bills on December 31st because we are seeing patients on New Year's Eve. We have not collected that amount of money yet. So there's probably, we probably haven't paid for any of our December bills yet. Probably not most of our November bills. So those are all floating out there waiting for the insurance company to send a check, right? So some percentage of those bills is probably never going to be collected. We don't know quite what it is, but we have in mind that it's some percentage, right? And so that's our provision, same as the other time we looked at it. Now they have something called capitation revenue. We haven't really talked about capitation yet, but capitation is basically a way of charging your patients or charging the insurance company, where the insurance company says to a doctor's practice, you're going to take care of our patients. We're going to give you $50 a month to do all of the, let's say in this case, the primary care, all of the primary care for this patient for the year. So we'll pay you $50 a month. So what goes into that line is $50 a month times however many patients they have under that arrangement. So if they have 10 patients, they'd be getting $500 a month in revenue. 500 times 12 would be $6,000 a year in capitated revenue, right? So that would go in that line. Because it's patient service revenue, it's just coming in it's not coming in as fee for service, it's coming in as capitated revenue. So we're separating them out. And then they have some other cats and dogs that are related to that. Maybe they, provide coverage for high school football games or something like that. That's an ongoing arrangement that they have. Or they might have a contract to do some other kind of service. We don't know what it is. It's small enough that they're just kind of calling it other. So there might be several things that are kind of lumped together there. So that gives us our total medical revenue, right? In other words, we're medical practice. Medical revenue is our core purpose for existence. That's our operating revenue. So they're not using you have to get used to the fact that they can tweak what they call the lines to some degree. I'm looking at that because I'm familiar enough with it that I'm like, oh yeah, that's just their operating revenue. You got to kind of get to that point too, be like, all right. And the way you could do that is say, well, what comes after that? Well, costs. Okay, well then that's not operating revenue. So now we're into operating costs, right? Operating expense or operating expenses. And they break their operating expenses up into a couple of categories to make it easier for them to analyze where their resources are being spent. That's perfectly okay. But note that it's clustered: first revenues, then expenses, operating expenses. And so everything that's going to come now is operating expenses. So operating costs, they're looking at what they're trying to break out here are all of the costs of operating the practice, and we'll see in a minute, other than providers and other than like supplies and things that they're paying out. So this is basically, they've broken out their manpower costs other than the providers. It's fine, right? So this whole section, operating costs, general operating costs, and then you'll see provider costs are all their operating expenses, and it all lumps together. So that first section of operating cost is basically support staff. The second section is other expenses other than support staff, such as how much they're spending on their medical record, their IT medical record, drugs, supplies that they're using in the clinic, their liability insurance, so their malpractice insurance, their rent, building and occupancy, other administrative supplies and services would be stuff like paper and pencils, right? Professional and consulting fees, so they're hiring somebody maybe to look at, prepare them for some sort of inspection. That would be a fee. They are sending out labs, so they're getting billed for laboratory services, radiology and imaging, right? So these are all things that it's just expenses of running the practice, and that's why they're listed here. And then they've got their marketing costs. So now you have, they come to total general operating costs, that's the section, and then they say total operating costs. Not quite yet. That's not how I would see this. But they're breaking it out. On an exam, I will not give you something this complicated. Don't worry. I'm just showing you kind of a more complicated version. Then they get into total medical revenue after operating costs, okay? And then they start subtracting off NPP. NPP is non-physician provider. So they've got some nurse practitioners and some PAs. So now they're getting into the cost of their providers. So they spent 690,000 on nurse practitioners, nurse practitioners. And so after NPPs, they've got 2.5 million left. Now you get to the physician costs. And this is where how much they're paying their physicians, 2.3 million. So net income or loss after provider related expenses is really their operating income. So for this statement, we're down to now, we've now gone through the operating revenues and the operating expenses, because the providers and their revenue, their salaries is a cost to running the practice, right? You're not getting any medical revenue if you don't have providers seeing patients. So that's a part. So that's why I'm saying this is all, even though they're kind of making it sound like it's not operating income, really is all the way down to physician cost, to less physician cost. So from the beginning of operating cost all the way down to this line, less physician cost, are our operating expenses. Then you get to net income or loss after provider related expenses. That would be their operating income. So their operating income is $164,000. All right. Then they get to what they're calling other income or expense, which is what we've been calling non-operating gains and losses. So looking at this now, interest expense. They're listing interest expense as a non-operating gain or loss. That is consistent with most other industries. Not-for-profit hospitals typically list interest expense as an operating expense. If you do it one or the other, I'm not going to take points off. But they've got it listed as a non-operating expense. I actually think that that's smarter, because if you think about it, if you understand, what is interest? Well, interest is based on how we financed the organization. How much debt have we taken out to run the organization? And how we finance the organization is different from how we operate the organization. And so to me, it actually makes sense to have interest expense in the non-operating section, because it's not an operational expense. Hence, it makes sense to put it in the non-operating gains and losses. That is not how hospitals, not-for-profit hospitals, typically do it. And I'll be honest with you, I don't know why, because it doesn't make sense to me. I've talked to a number of my counterparts in the civilian world. I've talked to a number of CFO types, and I'm like, so why do we do it that way? And they're like, well, we just do it that way. So there's an industry standard that goes that way. To me, it makes more sense to put it here where it goes. Then you have unrealized gain on marketable securities. And we talked about that. What's an unrealized gain? It means they've got some investments, they're carrying them on their balance sheet, and they've gone up in value. So they were worth $10,000 at the beginning of the year. They're now worth something more than that. How much is the unrealized gain? $15,000. So maybe they started out at $10,000. Now they're worth $11,500. That would be a 15% gain. But they haven't sold them. That's why it's unrealized versus realized. Okay. Investments are pretty much the only thing that gets adjusted to market each year. Meaning, if you bought a building and real estate market goes bananas like it has been for the last year or so, and your building increases 20% value, we don't do an unrealized gain on your building. We just carry the building at historical costs. And the difference is, you guys probably wouldn't know this yet, but the difference is it's really hard to know what your house is worth or your building is worth until you sell it, right? Whereas if you own stock in HCA, right, the company that owns Portsmouth Regional, for example, that's being bought and sold daily, constantly. Like every second, somebody's trading HCA stock. So we pretty much have a good idea, because it's just been sold a couple of seconds ago, what it's worth right now. And so we can adjust our investments to their actual value pretty easily. Getting an accurate valuation on things like equipment or buildings is actually really hard and expensive, so we just don't do it. So we use historical pricing for that. All right, so they've got, then they have gain on disposable equipment. All right, so that means disposal means they sold it. Doesn't mean they threw it away. It means they sold it and they made a gain. So probably what happened was it was depreciated at some point. They sold it for something more than its depreciated cost, and they had a gain. We'll get into that later. So that's it. Now we get to, I'm pretty sure that's a typo because they have interest expense net, and they're adding up all those things, and it's not all interest expense. It doesn't make sense. So I crossed that out as a typo. It's really other income net. So now they add the other income net to the net income after provider-related expenses, right? So 164, and they have a loss of 115, and so that gives them, so 164 minus 115 gives them $49,000 in taxable income, right? Income before provision for income taxes, 49,000. Then they calculate their taxes. They've got to pay $12,000 in taxes based on the $49,000 in income. That then gives them their net income. So it's the same structure as we just looked at, right? What have they done? They've done a lot more detail in their operating expenses. It's a little confusing, I realize, for you guys looking at it for the first time. But all they did was they just kind of blew it up into more granular detail. They took their operating expenses and they did a lot of detail. That's useful for analysis purposes, right? And so you get down here to net income or loss. Now, they have, now what we talked about with not-for-profits is they have this income. For-profits, you have this income. They have investors. Probably the physician practice is owned by the physicians. The practice made $37,000 in profits after they pay their taxes and all their other expenses. They can do two things with that. One is they can keep it and retain it, which is what it looks like they're doing here, is they can retain it in the practice, use that $37,000 to buy more equipment or do some other kind of investment. The other thing they can do is they can pay that $37,000 out in what? Do you remember? What's it called when a corporation pays out its extra income? Right? Dividends, right? A dividend, when a corporation pays out profits to its investors, that's called a dividend. Right? So in this case, what we can see is they had retained earnings. So when a company retains its net income in order to reinvest it, that's called that is called retained earnings. Right? So at the end of the year, that net income, that $37,000, has to become one of two things. It either becomes a dividend paid out to the shareholders, or it becomes retained earnings. It has to be one of the two. So in this case, what they're telling us is their retained earnings at the beginning of the year was 400,000, and the retained earnings at the end of the year is 437,000. So what we know is they kept the whole thing. The practice kept the whole thing. They didn't pay any dividends. Let's say they had paid out $10,000 in dividends. What we would see is a line for dividends paid of $10,000, and then the retained earnings would be 37 minus 10, 27. So the retained earnings at the end of the year would be, instead of 437,000, would be 427,000. Does that make sense? Okay. We'll do more with retained earnings here in a minute. Now, what I told you, let me see if I've got, what did I skip over? There it is. So they've got $37,000 in net income. Right? And I told you last time I was talking about this idea of napkin math or back of the envelope math. I was saying, all right, what's a quick and dirty way of estimating, because this is an accrual basis firm, right? Meaning these transactions don't necessarily represent cash. How much cash did they actually bring in this year? And what did I tell you the quick and dirty way to estimate how much cash an organization brought in was? Just looking at the income statement. Okay, you're going to need to know this for the test. I will ask you this on the test. The way that you estimate the cash flow, and it is a dirty, quick and dirty, not totally accurate version, but it's a quick, like I said, napkin math, kind of like, it's pretty good, is I'm going to take the net income and I'm going to add back the depreciation. So they've got depreciation of, there it is. They've got depreciation of 120,000. All right, so net income of 37, depreciation of 120. Approximate cash flow, CF is cash flow, approximate cash flow of 157,000. So it gives the appearance that they only brought in $37,000 in cash this year. In reality, they had roughly $157,000 in cash. Why am I adding back depreciation to their net income? To estimate how much cash they actually brought. Okay, so because depreciation is spread out over a certain amount of time, yes. But what am I doing with it? Is there any money going out in this when I spread that out? Right. So it's a representation. So what Brianna was saying was, it's just a representation. We really bought the thing, whatever these things are, last year, the year before, or whatever, right? We really spent the cash on them a while back, and now we're spreading that cost as a representation of the economic value. But that 120,000 that we saw on the income statement does not represent somebody writing a check and sending it to somebody to a lender or something like that. It is just a economic representation of the value that we used up that year. So there's no cash involved. It is a non-cash expense. Right? So depreciation is called a non-cash expense. There's a few of them like that. That's the one we'll see the most. So, and it's usually the biggest one for most organizations. So if somebody said, hey, here's an income statement, estimate the cash flow. Somebody like me said that to you on a test, which will happen. If I say that to you on the test, you're going to add that 120,000, whatever the depreciation number is, back to the net income, because depreciation isn't a real expense. Or it isn't a cash expense, I should say. It's a real expense, it's not a cash expense. And what I'm asking you is, how much cash does this organization really have at the end of the year? And at the end of the year, they really had $157,000 in cash, not $37,000. Okay. All right. back up for a second. Going back to the Exeter statements. So the Exeter statements, we're going to focus in on the excess of revenues and other support and non-operating gains over expenses. That's their net income. It's 19,027,718. Now we want to figure out what their approximate cash flow was. Well, their approximate cash flow, in order to do that, we need to know what their depreciation expense was. So we go back up here and find their depreciation expense, and depreciation was 643. 8,643. So their approximate cash flow is, I'm not going to bother, actually, you would add these two together, so that I'm just going to do 15 and 19 because these are pretty close to zero. So that's 34 million, roughly 34 million, right? That's what I'm calling it anyway. I'm going to say it's about 34 million. It's not completely accurate because there's a whole bunch of other things. If we were doing the actual cash flow statement, there's a whole bunch of other things we've taken into consideration, some of which have nothing to do with the income statement. Okay? But this gives you a pretty good idea of how much cash the organization brought in. So even though their net income said it was just 19 million, the actual cash flow is closer to 34 million. Allison.
So when it says 19 million, and it says excess of revenues, other support, and non-operating gains, that's the same thing as that.
Net income.
Okay.
Yeah.
So it doesn't actually have the same net. That's just another word for it.
Yeah, that's just the way they're talking. That's the way you will see it on a not-for-profit income statement. Typically, it's some statement like that. They don't say profit or net income. They will say excess of revenues over expenses or some variation thereof, which is what you're seeing right now. You got the wrong one. Keep that one. Oh, yeah, that's the other. That's the backup. That's backup to it. You all got that one? I've got a bunch. All right, so there were 2 pages. Yes. So if you don't have the first side, who's not got the first side? That's right. That's the actual income statement, not just the notes. All right. Last thing I'm going to do with this chapter is calculate two ratios. So let's go back and look at Exeter. All right. The first ratio we're going to calculate is called the operating margin. Operating margin. Abbreviated OM. The operating margin is the operating income divided by the operating revenue. So I'm sticking in this ratio. I'm only looking at the top 2 sections of the income statement. I'm looking at the total operating revenue and I'm looking at the total operating income. So for Exeter, total operating revenue is 328. 046 316. Sorry, that's the operating. Operating revenue is 328,046,316. Operating revenue is this line, total operating revenues and other support. Then I want operating income, which is the income from operations in this case. That's 175,561. So if we take out our handy calculator, we can say, all right, 175,561 divided by 328,046,316 is going to be a really tiny number. Okay. So that is 0.05%. So it's 0.05%. Oh, you're not seeing that. There you go. So I took the operating income, which is the 175,561, divided by the operating revenue, which is 328,046,316. That gives me a super tiny percentage. That's the 17 operating margin. How about the 16 operating margin? I'll let you do that. So you've got the 16 is the next column back. You all are sitting there with it in front of you. So the 2016 net income from operations is what? Who's got it? You're assiduously not looking at me. It's a number. Tell me the number.
3.17.
Oh, I meant the net income. You're ahead of me. Yeah, that's about right. What was the income from operations? You got it, Luna. So what? It's the 10,058,000, right? All right. So I'm gonna write down 10,058,993. Then I'm going to divide it by operating revenue. Oh, that's the operating revenue, 314, 241, 578. And let's just divide. 10,058,993 divided by 314, 241, 578. So Luna said it, 3.2%. So big difference. What does that tell us? Dividing operating income divided by operating revenues. So what that tells us is roughly how good are they at converting revenue into income? Because we don't really care about revenue. What we care about is what we get to keep, right? And in 2016, their operating margin was 3.2%. So they got to keep 3.2% of everything they brought in revenue. In 2017, they kind of stank, right? They only kept 0.5% of what they, half of a tenth of a percent. So 5/100ths of a percent. So not 0.5%. That would have been even better. That would have been better. But 0.5%. It's pretty bad. Pretty bad. Not half bad. Yeah, whatever. Anyway, I can't. 0.05%. There we go. So they kept this tiny, tiny fraction. They're not doing a good job in 17 of converting revenues into income. So what we look at when we look at ratios is two things, two ways of looking at ratios. We look at them over time. So here was 16, here's 17. Are we going up or are we going down? Well, some ratios we want to be bigger, and some we want to be smaller. This is one where we want it to be bigger, right? A bigger operating margin says we keep more of the money that we bring in revenues. really what this measures is how good are you at controlling your costs? And in 2017, they weren't very good at controlling their costs. Their revenues went up. We talked about that, right? You can look at it. Their overall revenues went up. They went from 314 to 328. That's good, right? But their overall expenses went up too by quite a bit, from 304 to 327. So their expenses went up faster than their revenues. So they're not doing a great job at 17 of controlling their expenses. So that's what causes the operating margin to fall. So what you want to do is look over time. You want preferably multiple years to look at over time and to be able to determine, are we heading in a good direction? In this operating margin, you want to be steadily climbing if possible. Or are we heading in a bad direction, which is what this is, going downward. So if you're an analyst or you're a senior leader and you're seeing operating margins going down, you are very concerned. All right. The other one we're going to work on is called total margin or profit margin. And the book goes back and forth both ways. So in chapter 3 and 4 and early on, they call it profit margin. Then later they'll call it total margin. So it's the same thing. And that is equal to net income divided by total revenue. Now, total revenue is equal to operating revenue plus non-op gains and losses. So this actually involves a second calculation. So we'll go down here. In 2017, their net income was 19,027,718. That's easy. 19,027,718. Their total revenues, we talked about a second ago, is 328,046. $316. And then they had non-operating gains and losses of 18,852,157. 18,852,157. Sorry, right small there. Okay, so now we add the bottom. 328,046, 316 plus 18,852, 157 gives us 346, 898, 473. And then we're going to divide 19 into 346. What do you get? How much?
5.5.
Sounds about right. Yeah, 5.48, some change. 5.5 is fine.
Total rev equals operating revenue and what's it?
Plus
Plus
non-operating gains and losses. There's our non-operating gains net, 18,852, and our total revenues, 328. So how about 2016? So 2016 net income was 15,453. Then we have to get their total revenues, operating revenues, 314, 241, 578. And then we need their non-operating gains. 5,394,719. Now we're just add that together. 314, 314, 241, 578 plus 5,394, 719, 319, 636, 297. And if you're using a smartphone, you can go to your scientific calculator version, which you do by just turning it sideways, and you can hit the 1 over x, invert the bottom, and times 15, 453, 712, and you get 4.8%. So they actually went up from, so this was 17, this was 16, right? So 4.8 to 5.5 is a good increase. What did we see last time? What did we see in 17 versus 16? How was their operating income in 17? We just looked at. Was it good? Bad? How much was it? Yeah, 175,000 in operating income on $320 odd million in revenues, which gave us that super tiny 0.05% operating margin. So that's crappy. That's bad, right? And yet they had an improvement in their profit margin. What was it about 17 that saved their bacon? We talked about it. Their gains from what? So they had a very small, their investments, right? We talked about how they had all these huge gains, 13 million, 2 million, 2 million, right? All these huge gains from investments that generated 18 million in non-operating gains, even though their operating income was terrible. It was almost zero. It was basically zero. When you're 174,000 on $328 million is essentially zero, right? It's like what we call budget dust. If you bring in 328 million and you're like, look at me, I got $175,000 left over, nobody's going to smile, right? Except they're going to be like, oh, isn't that adorable? Right? And not in a good way. Yeah, Joyce.
I'm sorry, I didn't understand the second ratio that we're calculating.
Yeah, profit margin. Okay. So profit margin is, so that what's the difference between operating margin and profit margin? Operating margin is focused just on the operations of the organization. We're taking the operating income, the income that came from running the business, and dividing it by the revenues that the business brought in, doing its core business. So the operating margin is really focused on the core business of the organization. So in this case, hospital doing patient services, right? Profit margin. Profit margin now doesn't just look at how much revenue you brought in from running your core business. It brings in all of the resources that you brought into the organization, whether that was from running your hospital, or whether that was from selling a building, or whether it was from getting gains on your investments. Now, all that other stuff, other than the money that they earned from running the hospital, you kind of look at it and you're like, well, you made a bunch of money on stocks. You're a hospital. I care, like it's good. I'd rather you make the money than not make the money, but that's not why I hired you, CEO, right? And oh, by the way, you and I both know that next year the market may just tank for no apparent reason that has nothing to do with you and your hospital. and we'll see a complete reversal of those gains, right? So we were bumping along happy, fat, dumb, and happy. The stock market was doing great in February of 2020. And then all of a sudden COVID hit, the stock market took a 40% nosedive. So if you were like cruising along thinking, I'm going to have a great non-operating gain to plug on my income statement, no, you didn't, you know, and it really had nothing to do with you. Right? So the profit margin measures the total amount of resources that the organization is able to keep in the form of net income divided by the total amount of resources that they brought into the organization. So it's still kind of a cost control measure. You keep more if you do a better job of controlling your costs. The difference, the key difference is operating margin focuses just on the core business. Profit margin includes all the other random, includes the core business, plus any other random stuff that happens to happen to the organization that year. Okay. For nonprofits, that's probably most likely going to be investment income. So that's the main difference, Joyce. Does that make sense? Yeah. Okay. That's it for 17. Excuse me, for 17. For chapter 3, we're moving into chapter 4 now. We're going to talk about the balance sheet. All right. So here comes the Exeter balance sheet. We're going to look at it. There are 2 pages now. I tried to get it to staple and it didn't. We must be out of staples or something. All right. Balance sheet. Is everybody getting 2? They're like back to back. So if you took, you should take 2 off the top. So one should be titled, one should start with assets, and the other one should start with liabilities and owner's equity. Or liabilities and net assets. What? You didn't get any? There's 22 copies floating around. All right, while you guys work that out, I'm going to keep talking. So the balance sheet. Got a bunch over here. Is that yours? Oh, no. All right. The assets is first. All right, so the balance sheet. Whereas the income statement is capturing the flow of revenues and expenses coming in and out of the organization. The balance sheet captures a couple of things. The stuff the organization has and how the stuff is financed. Right, so think of your parents' house. Like I imagine most of you guys don't own a house yet, but think of your parents' house. Have you guys ever gone on Zillow? Maybe not. Maybe yes. Okay. So Zillow, you can go on Zillow, and like I could be like, all right, where does Paige live? And I get Paige's address. I look her up in the UNH systems, and I'm like, I'm gonna go see how much Paige's house is worth. I put it into Zillow, and I get it's $850,000, right? And I'm like, oh, that's a really nice house. Let me see. So, there's pictures from when it was on sale last. Oh, there's Paige's room. That can be totally creepy. Now, what that tells me is how much is the house worth? The house itself is the asset. An asset, the way I think of it is an asset is a thing you can touch, right? You can spend it or you can sell it. This is kind of a good general rule. If you're on the exam and you're like, I don't know if this thing is an asset or not. You run through those 3 tests in your mind real quick. Could I touch it? Right? Can I spend it? Like, is it cash? Cash is an asset. So could I spend it? Right? Or could I sell it to someone? Will somebody buy this from me? Right? Does it have some sort of value where I could give it to somebody and sell it? Those are the only 3 things those are the 3 things that make up an asset. So house, definitely an asset, right? I can definitely touch it. I can't spend it, but I sure can sell it, right? And right now Zillow's telling me I can sell it for $850,000. What it doesn't tell me is whether Paige's parents have a loan on it or not, and how much of a loan on it they have, right? Now, most people carry a mortgage. I carry a mortgage on my house. So let's say it's worth $850,000. Paige's parents have a $400,000 mortgage, right? So what's their equity? It's an $850,000 house. They have $400,000 mortgage. What's their equity? How much of the house do they own? Roughly, right? 400 is just about half of 850. So the bank owns $400,000 of the $850,000 house, and they own $450,000 of it, right? 400 plus 450 is 850. So the 2 sides have to match. The value of the house has to equal the bank loan plus what we call the equity that Paige's parents have. Right? If you have a car, you have a loan on your car. Let's say your car today, you go on Edmunds or Blue Book or one of those things, and you say, how much is my car worth today? And the thing says, oh, it's worth $10,000. Hey, great. I have a $5,000 loan on my car. How much equity do I have in the car? 10,000 asset minus the liabilities, 5,000, says I own $5,000 worth of the car. That's called your equity. If you had an $8,000 loan on your $10,000 car, you would have an $8,000 liability. You owe the bank $8,000, and you would have how much equity? Sorry? Car's worth 10. You still can't see it. All right, car's worth 10. Now it's just messing with me. All right, people watching at home can see, so I'm just going to write it on the board. Car's worth 10,000. Loan 8,000. How much equity do you have? 2, right? So you own, essentially, what that tells you is, the way we're going to look at this is 10, right? This is your asset, has to equal your liabilities, which is, in this case, was 8, plus your equity, right? And so 10 minus 8 is 2. So for folks watching at home, what I said was assets equals liabilities plus equity. 10 equals 8 plus 2. Huh? So this is a formula that you'll want to remember. Assets equals liabilities plus equity, and then you can rearrange it and say assets minus liabilities equals equity. Just rearrange it. But if you can just remember assets equals liabilities plus equity, that'll get you a long way. So assets minus liabilities equals equity. So that's basically what the balance sheet comes down to. So you've got in front of you, you've got two sheets. One says assets, and it's a list of assets. The next one says liabilities and net assets. Not-for-profits, of course, use a different word. Instead of calling it equity, they call it net assets. So it's net of liabilities. Okay? Net assets are not liabilities and they're not assets. They're net assets. They are the equity. We'll make more sense of that in a minute. Okay, so some basics. The balance sheet is a snapshot in time. So the income statement is always over a period of time. It's what we call the flow document, right? It captures my revenues and expenses that came in from January 1st to December 31st, or from April 1st to April 31st. So 31st of April, yeah. Or wait, is there a 31st of April? No, it's April 30th. Okay, so April 1st to April 30th. Of course, I pick a month, but I can't remember what it is, 31st, right? Or I can do it January 1st to March 31st for a quarter. Or I can do it January 1st to June 30th, which I know has only 30 days. That's my first 6 months of the year, right? So I could do it, but with the income statement, I'm always doing it over a period of time. The balance sheet is like, you go to an ATM and it says, do you want your balance? And that's your balance like right now, right? It's not your balance over a period of time. It's your balance right now. It's how much money you can take out of the bank right now. So that's what the balance sheet is. The balance sheet is a snapshot in time. We call it a stock document, meaning how much do I have in stock, if you will. So as opposed to a flow over time, this is a snapshot in time, a stock document. All measured in dollars. This is some other details that you don't really. So the balance sheet, like I was showing you on the board and on the white on the camera there, has got two sides to it. This is how I think about it. I told my wife this. She's a tax accountant, and I said, "Yeah, it's like the left side and the right side of the balance sheet." She's like, "What are you talking about?" And I'm like, "Yeah, you got assets on assets on the left and liabilities and equity on the right." She's like, "No, they just go assets on top, liabilities and equity on the bottom, which is how your sheet would actually show it." And I'm like, "Whatever, honey." It's easier for me to think about it this way because what I can now do, and those of you watching at home can't see me doing this, but it's like a little, like remember the song, like in preschool, you say, "I'm a little teapot, short and stout," right? Yeah, right. So think of it like a scale or like a teapot. Like I've got this thing exactly. I've got this thing sticking out. I saw that. I've got this thing sticking out, right? So on the one side, I have assets. So I have my car that's worth $10,000. On the right side, I have my liabilities and equity. And in order to be in balance, so think of it like one of those old-fashioned scales where you put like weights on one side, you put the stuff on the other side. You guys use that in chemistry or use something fancier? You have the scales, classic with like the little brass grams, and you put them on the scale to measure. So you know what I'm talking about. So you put the weights on one side, you put the stuff that you're measuring on the other side. It's the same thing. So I've got to have the same total on my asset side as I do on my liability side, and I have to be in balance. That's why we call it a balance sheet, which is why it has a left side and a right side. You guys just go tell my wife. That makes sense, right? If you think about it this way, left side, right side, they have to be in balance. Otherwise, if my assets are bigger than my liabilities and owner's equity, I'm like this. My liabilities and owner's equity is too big. I got like this. They have to be equal. So when you add together your liabilities and owner's equity, they have to add up. Just like when I said with your car, if you've got an $8,000 loan on your car and it's worth $10,000, then your equity is $2,000. If you've got a $5,000 loan on your $10,000 car, your equity is $5,000. Has to add up to 10 has to be on this side and 10 has to be on this side, right? So it's in balance. If I write 10,000 over here and a total of 7,000 over here, it doesn't balance. Something is missing. So the asset side of the balance sheet, or if you're my wife, the top part of balance sheet, captures all the stuff that the organization uses to conduct its business. The right side or the bottom half of the balance sheet is who owns the stuff, who has claims on the stuff. And so there are liabilities. Think about banks, suppliers who have sold you stuff and you haven't paid for them yet. That's a liability. You owe them money for real. If we get sophisticated and you're taking out bonds, issuing bonds, those are just loans. You're issuing them directly to investors rather than to a bank. That's really the only difference. So a bond is a loan. That's a liability. Then you have your equity, and your equity basically just balances out whatever the asset value is minus your liabilities, ultimately. That's a little fancier than that, but that's the bottom line, is this equation has to be true. The assets have to equal, the value of the assets have to equal the sum of the liabilities in the owner's equity. So when you go to take the exam, and I give you a problem to work out a balance sheet, a simple balance sheet, when you add up your assets and you add up your liabilities and owner's equity, those two numbers have to match. And if they're not matching, you've done something wrong. Right? That's the beautiful thing about the balance sheet is it's self-correcting. Well, it's not self-correcting, but it will tell you you've done something wrong. Right? Where the income statement you won't know until I grade it. But if your assets don't add up to your liabilities and owner's equity, you know you've done it wrong. And so hopefully you go back and fix it until you get it right. And it's usually because you're calling something an asset that's not an asset, or you're calling something one of the other things, and you've mixed them around. So let's look at what you've got in your hot little hands right now. The asset statement for Exeter Hospital for 2016 and 17. So there is a standard format for reporting assets, and it's basically in two sections. The top section is called current assets. Current assets are things that are going to be are cash. So cash is at the very top. Things that are cash, are close to cash, can be converted into cash easily, or are going to be used up within a year. So cash equivalents. So a hospital literally has some cash, like dollar bills and coin, sitting in it. Usually not very much, relatively speaking, relative to their total revenues. Most revenues come into the hospital through their billing system, but they've got a cafeteria. They've got other kind of, some people might pay the ED and, their copay in the ED with cash. So they have some small amount of actual cash. Most of what they have are what we call cash equivalents. Cash equivalent is a bank account, right? In particular, a checking account. A checking account, the money in a checking account is treated as cash. And you can just write a check and you can basically use it like cash. So the money in a checking account counts as cash. Money in a savings account, basically, I think it's also cash, but I'm blanking right now. Then you have short-term investments. Short-term investments are kind of, rather than just being able to write a check off of them, you might have to liquidate them. So a short-term investment would be something that probably the most common short-term investments are holdings of treasury bills. So federal short-term bonds issued by the federal government are called treasury bills. Next semester, we'll spend a lot of time talking about this. They used to be sold in $10,000 increments. So basically, you have to be a pretty wealthy investor or a big organization that had a lot of cash that they wanted to put into something short-term that earns interest. So if you buy a T-bill, the short-term you buy a T-bill, you're earning a small percentage of interest on your investments. Not very much, but it's better than zero, which is what if you have a corporate checking account, you make zero interest on your checking account. So if you've got a bunch of cash, like say 44 million, 5 million in short-term investments, it's better to have 5 million earning some interest than earning zero. So corporations will put some of their money in cash in their checking account and some of their money in short-term investments. And those two are basically treated as cash for accounting purposes. So that stuff, short-term, current asset, is it cash or easily convertible into cash? Well, the first one is yes, it's cash. The second one is it's easily convertible into cash. If I've got T-bills, literally trillions of dollars in T-bills trade every day. If I've got $100,000 in T-bills, I can sell it like that. It would just be a pebble in the ocean, right? Or a drop in the ocean, whatever. And nobody would even notice. It would just go on. I would get it to cash right away. Now, this next line is more interesting. It is accounts receivable, less allowance for doubtful accounts. Okay, so accounts receivable. What is an account receivable? When Molly goes to the doctor and she's got Cigna insurance or whatever, she sees the doctor. They're like, okay, Molly, today is a $20 copay. The total visit is $100, but there's a $20 copay. Molly takes out her credit card, pays the $20, or hands them a $20 bill. The hospital or the clinic now reports, we got $100 in revenue, but $20 in cash, and we're sending out a bill for the remaining $80. That bill for the remaining $80 gets accounted for in the accounts receivable line. So the organization has $100 in revenues, 20 of it goes into cash, and 80 of it goes into accounts receivable. And we'll work on those transactions later. So really, what is accounts receivable? It's the amount of money that we've sent out in bills that we're waiting to be paid. They are IOUs that are due to us, right? So Cigna owes us $80. The accounts receivable represents the $80 that Cigna owes us. So when Molly sees the doctor, cash goes up by 20 and accounts receivable goes up by 80. Okay. Now, when Cigna pays the practice the $80 that they're owed, accounts receivable goes down. We zero that out. There's no more IOU. And cash goes up another $80. So now we have $100 in cash and zero in accounts receivable. This happens every day, all day long, in a healthcare organization, right? People are coming in, getting seen, they're paying their copays, the organization is sending out bills, and then insurance companies are sending cash to pay off the bills that they received on behalf of their patients. So it's this constant cycle of accounts receivable going up, cash coming in, accounts receivable going down, right? And it's constant. And what happens, it's kind of like, imagine you're in a bathtub, right? You're running water in your bathtub, right? You put the plug in the drain and you turn on the spigot and water starts flowing into the bathtub. What happens? Water starts to accumulate, right? The water level starts to go up. Now, if you pull the plug out of the drain, water starts to go out. But if the faucet's still running at the same time, you can kind of eventually, if you wanted to mess around long enough, and your water flow is fast enough, you could probably get to where your water coming in is exactly matching how much water is going out, right? And then even though there's water draining out and water coming in, the level would be constant. That's kind of what it's like running a healthcare organization. The level of water in the tub is like your accounts receivable. You've got new accounts receivable coming in every day when your providers see patients and they send out new bills. When a bill goes out, the accounts receivable goes up. That's like the water coming into your tub. When the insurance companies pay their bills and send cash to the organization, the accounts receivable go down. So most organizations, all healthcare organizations, have a continuous accounts receivable balance. They don't want it to get too high, just like you don't want your tub water to get too high, because that means they're not getting paid in a timely manner. Because ultimately they want cash, they don't want accounts receivable, right? They'd actually love it to get it to near zero, but that'll never happen because the insurance companies don't have any motivation to pay them any faster than they need to. That's called float. So it's like a free loan to the insurance company. Because when the insurance company hasn't paid the bill yet, what they do is they take the money and they put it in a T-bill and they earn interest on the money that they haven't paid yet. So healthcare organizations always have some level of accounts receivable. They're always trying to get it down, but there's always new bills coming in that are raising the accounts receivable level. So if you guys, some of you will graduate and become revenue cycle managers, which means you manage, your purpose in life is to manage the flow of bills going out of the organization and cash coming into the organization. So you're a tub manager, basically, right? It's a little more sophisticated than that, but that's basically what it comes down to, is you're constantly trying to push the level of the water down. So accounts receivable is I have sold something, whether it is a visit in my physician practice, whether it's a scan at my radiology practice, whether it's an inpatient stay at my hospital, whether it is, whatever, a day in my mental health unit. Those are all payments those are all bills that are going out that I'm waiting on payment for. So accounts receivable is I've sent out a bill and I'm waiting on a payment. The amount of money that I'm waiting to be paid is my accounts receivable. Okay. Now, these are usually resolved within about 60 days, which is a lot less than a year. That's what makes them current assets. Right? So it's an asset in the sense that I could actually sell this, and some organizations do. It's a process called factoring. And there are investors who will buy the accounts receivable from me and give me a percentage of the amount that I'm due. All right, so that's that line. Inventories. That's the stuff that we're going to use up. So that is in a hospital, it might be syringes, drugs, all that kind of stuff. Carrying inventory that I'm going to use. So I'm carrying it as something I'm going to use but haven't used yet. Prepaid expenses and other current assets, so we're lumping some stuff together. A prepaid expense would be, for you guys, it might be something like, I have a subscription for a magazine. I've paid for a year's subscription. That's a prepaid expense. I haven't received all 12 issues yet. I've received one. So I would have 11 months of prepaid expenses for my magazine subscription. And as I receive the magazines, my prepaid expenses would be going down. We're going to skip current portion of funds. That's fancy stuff we don't really need to know. So then we just add those stuff up. So the main things that you're going to see in on an exam, and you'll see everywhere, are current assets. Under current assets would be cash and cash equivalents, short-term investments, accounts receivable, and inventories. Those are the ones you'll see all the time. All current assets. All right, we'll pick up next week. Oh, quick announcement as you pack up. You should have seen an invite from Kate McAllister, October 4th. You're going to have a virtual networking event. So they're going to invite some young alumni we'll do a big Zoom call, and you'll get a chance to kind of break out into rooms with the individual alumni. It's a great opportunity to make some connections with folks who really want to help you out. Hopefully I'll see a bunch of you tomorrow. If not, have a good weekend.